All right. So thank you so much. Today we have another podcast episode with the Forbes Podcast with conversations where we like to inspire, empower, and educate our audience. And today I have joining us, we have Sean Smith and Devon Noble, who are the co-founders of Freedom 10. You guys have created this company as a tool to help individuals pay off their mortgage faster. And between the two of you, I believe you have combined over 20 years of mortgage experience and have helped thousands of families. So this is amazing. Thank you guys so much for joining us.
Thank you for having us, Penny.
I'd love to start off with sort of how your story began. How did you guys get into the financial industry and what created this company in Freedom 10?
Yeah, I'll start because Devon's is more interesting, but I've been a mortgage broker for 15 years, and Devon came on as my business partner about 7 years ago. And then the past couple of years, we've started building different companies like Freedom 10. So I'll let Devon talk about his history, then we'll get into how we got to Freedom 10.
Love it.
Before kind of jumping into mortgages with Sean, I was at CI and First Asset on a product management, product development space. So effectively, I come from a pretty technical finance background. We used to design and construct new investment products for pension companies, for individuals to invest in. And when I wanted a change, Sean presented the opportunity of joining him with the mortgages, and we've been kind of looking for ways to go beyond what a standard mortgage broker can do, which is obviously to help people plan accordingly with their debt. But we really wanted to find a niche that allowed us to make material impacts on people's lives. So we started to dig into some of the different strategies out there. That's when we landed on some of the main ones that we practice today. And ultimately, we just want to help people get out of debt as quickly as we possibly can.
That's amazing. I think that's especially in Canada and in Ontario where we live, debt is such a heavy load for people. So what you're doing and going in on this niche market, I think is quite incredible. And I think on your website, you see the results speak for itself too, right? Like hundreds of thousands of dollars saved, paying off their mortgage in less than, or 10 years earlier, mortgage free. Like these are great goals that people want to achieve. And sometimes I think people just get lost and don't really know how to do it or where to start. So the fact that you guys have that experience and are doing this every day is incredible and makes a big difference.
Yeah, and Penny, it's funny. Those are real people on the website. I know like a lot of people will put fake stuff up there, but we could literally post. We have probably 5 to 8 conversations with people every day.
Wow.
Where we could share similar results like that, where we've shaved years off their mortgage, hundreds of thousands in income taxes and mortgage interest saved. So these strategies are very powerful.
Amazing. Okay, so let's talk about then Freedom 10. Tell me what it is. And I know when I first heard of it too, and I have an accounting background, like for a lot of people, I think this concept can be overwhelming, but I think you guys do an excellent job on your website too of really with your mini course making it simple. What is it that you do? It's rental cash damming. And I know that there's another portion too, which is the Smith maneuver. Let's break it down into simple terms of what exactly it is.
Yeah, so our goal is to help people turn their mortgage into a wealth building tool. And there's several different, what we call debt conversion strategies to help them do that. And Penny, I'm sure you're aware, the 2 biggest expenses in most people's lives are income taxes and mortgage interest. So you can look at different ways to go make money. You can try to get a raise, you can start a side hustle, you can get a business going, but you should also be looking at ways to reduce how much income tax you pay and how much mortgage interest you pay. And in Canada, most people's mortgage on their primary residence is not tax deductible. And that means that you can't use that interest each year to lower your income taxes. There are strategies that you can do to convert that mortgage over time or in one shot into a tax-deductible mortgage, meaning you can claim that interest against your total taxable income and eventually get tax refunds potentially or reduce that tax burden completely. One of our favorite strategies is called rental cash damming, and it's very similar to the Smith maneuver. But with the Smith maneuver, you're maintaining debt levels over time to grow an investment portfolio. With rental cash damming, you're using rental income to reduce your primary residence mortgage really quickly and convert that mortgage into a tax-deductible loan. And the reason we called the company Freedom 10 is because Devon does this strategy on his own mortgage. And if he structures it in a certain way, he can get completely out of debt in 10 years. And there's two ways that you can go about it, which we'll dive into later, but one of the ways would actually get him out of debt completely in 10 years. So that's why we came up with the corny name Freedom 10, but it does have a meaning behind it.
I think it's great. Who doesn't want to be mortgage free in 10 years?
Yeah.
That's an outstanding goal.
Yeah.
Okay, so that makes sense. Now, who is this, again, is this for everyone listening? Who is this strategy best suited for?
I'll let Devon answer this one. He's the technical genius.
So the strategy fits best with those who are obviously high income earners. The more income you make, the more taxes we pay. So the greater the impact you generally see. And for the most part, high income earners take on larger debts because you're looking at more expensive housing, or you're in areas that would require you to have more debt to be able to fund lifestyle. So generally speaking, you see this work really well for those mom and pop real estate investors who have high taxable income, currently high levels of debt, and are really just looking for ways to get ahead. That's who it's really best suited for. But the reality is this can work for a lot of folks. Anybody who does real estate investing should look at this. Specifically the mom and pop investors, somebody who's got one, maybe two rental properties in your personal name, and you're still carrying a mortgage on your home and you're just looking for a strategy to get ahead.
That's amazing. Okay, so high income earner and someone who generally has a rental property, 1 to 2 rental properties. Now, high income earner, I think, is a different term to many people. So your typical client, who is that high income earner? What's that income threshold?
We work with clients across the country, which is nice with these types of strategies. You generally see kind of high income thresholds different in every province. We'll use Ontario because that's where we're all located. Generally speaking, you're seeing kind of household income between 2 to 200,000 plus. That's generally where you see your income start to hit meaningful marginal tax rates, which is just the highest bracket of tax that our dollars would be in. And that's really where you can get the material benefits of being able to write off your interest, right? When we're able to, similar to an RSP contribution, reduce a personal income because we're creating an expense, we get to shave off the taxes associated with those dollars of income. And that's really where you see the material impacts.
That's great. And is it also beneficial? So it's for someone who has a rental property, is it also beneficial for someone who does an Airbnb out of their house, or someone who rents a portion of their house or their basement?
So it can absolutely be done with anybody who rents like a basement apartment in their primary residence. Absolutely. We do see a lot of significant impacts with that application of the strategy. Airbnb is the one thing that we generally say it's not worth pursuing if your rental source is through an Airbnb property. The challenge with Airbnbs right now is there are so many kind of new regulations and changing rule environments from the government that may impact us down the road. And our goal with clients is to make sure that they stand the best chance of seeing the full benefits. The last thing I want to do is have somebody start this and then in 2 to 3 years' time be unable to see the full benefits because of a rule change that now applies.
And just to cut in, sorry, one of the things to point out is we build these models up front based on anticipated rental income and stuff. So if that drops off, it impacts what they could do, but they could always convert that property to a long-term rental. We would just need to know that it's going to meet a minimum threshold of rental income for this to continue making sense.
That's great. So I think it's really beneficial to know, and I guess it's for individuals too. If someone already has like a rental property, say they have, like they think things are structured properly, they think they're deducting mortgage interest, is it still something that someone should reach out to you guys for to look at? Because I mean, from a personal perspective, whenever I dealt with clients when I was in the wealth management space, oftentimes these mom and pops or these business owners are so busy with their own lives that they really don't look into the details. They don't focus on it almost until decades later when they have the time.
So one of the funniest comments we get all the time on TikTok is, where were you guys 15 or 20 years ago? So absolutely, it's never too late to at least start the conversation, because maybe we can help, maybe we can't. But also, we chatted with a guy yesterday who does his own taxes and he has a rental property. And he had pulled out $95,000 from that rental property to buy his principal residence a couple of years ago. And he's been commingling that debt the entire time. So if you borrow for personal use, you cannot write off that income, that interest. So he didn't know that. And he would have gone the next 10, 15 years commingling debt. And if he got audited, as you know, he would fail that. So even just having us look at stuff like that, we can help him separate the debt, start tracking it properly. I would absolutely look into it.
That's amazing. I do think it's really important for people to know this. Like as you said, where were you 15 years ago? I think this is a great conversation to even share with family or friends, right, who have rental properties, because oftentimes, more than not, you think you're doing things right, and then you realize there's these strategies that were available that aren't being done. And I know that too. I think it's important to speak to specialists like yourselves because, and again, maybe we can give an example of how the strategy works so that people really understand what's a scenario where someone's doing it wrong and how can you help them rental cash dam to do it properly, and then what those risks are with even which banks you're using to implement the strategy.
Yeah. I'll start and then I'll hand it off to Dev.
Okay.
Because I have a point I want to make. A lot of people have rental properties in corporations. They've been advised to do that. That's still a great strategy. We're not saying you're messing up by doing that. There's just different ways to skin the cat. And this strategy is fantastic because it can pay off your primary residence mortgage much faster. And it can give you some income tax savings. But then you lose some of the benefits of the property being in a corporation. But if your property is in your personal name and you have a mortgage on your primary residence, you should absolutely be looking into this. We can kind of talk, I think now would be a good time on how this works. Like, how does the money move and how does it work? And then we can get into the other questions. So let's paint a picture. The typical landlord has a rental property and a mortgage, and they take the rental income and they make the mortgage payment on the rental property. That seems very obvious, right? That's how everyone does it. With rental cash damming, you take the rental income from the rental property and you apply it as a prepayment on the mortgage on your primary residence, in addition to your regular mortgage payment on that property. Well, now you have to make the mortgage payment on the rental. So you borrow from a specific type of line of credit on your primary residence to make the mortgage payment and cover the other expenses on that rental property. And you do this every month. And essentially what you're doing is paying down the primary residence mortgage very fast, but moving the majority of it over to a line of credit on that property. That line of credit is now tax deductible because it was used for eligible investments, which is an investment property. And every year that interest is growing and you're claiming it against your total income, not just the rental income. And typically people will get back tax refunds, which they use to pay down the primary residence mortgage even faster. So in a nutshell, that's how rental cash damming works.
That's great. I think that makes sense to me. But I think from an outsider too, and I believe when you guys speak to clients, you run these models, right? Which I think is amazing because every client situation is different. So to actually see the numbers for your situation and how it could benefit, I think is where the real aha moment comes in, I'm sure, for many people.
Yeah, it's really fun. We have really complex calculators that dive into each person's situation, and there's always a nuance. And I've just given a 30,000 foot view of the strategy. There's way more to it. Please do not try to do it on your own. Devon can kind of chat about, you don't have to say which banks do it or don't, but why some may be bad, and then kind of what pitfalls to look out for.
Yeah, so there is a limitation in terms of the products available to us as borrowers that give us the right functionality to be able to actually manage what we call that conversion process, which is where we're taking that mortgage down to zero and building up that tax deductible interest loan on within the HELOC. And so even between some of the banks that do offer it, in Ontario, there are about 8 or 9 of them that have the right product structure. But even within those, there are 2 or 3 that kind of stand out as materially better for us as borrowers. Because what you'll find with these strategies is anytime you're dealing with a 20-year strategy, and you'll know this paying for investments, same kind of thing, right? Life is going to change over a prolonged period of time. And what you see is life changes. And in life changes, you'd have to be able to adjust the mortgage structure. So it's not only just to make sure that you can execute the strategy simply, doesn't really kind of detract from your daily life in terms of the time that you have to put into it, but also protects you for when you are going to inevitably make those changes down the road. So generally speaking, if we can get clients qualified, there are 2 to 3 lenders that we work with predominantly to give people just the best experience, but also to protect them down the road. Because again, it all comes back to the same goal for what we're trying to do. We want to make sure that people are going to stand the best chance to actually see the results, which is actually getting out of debt. I want calls in 20 years and 15 years when clients are saying, I've got my mortgage paid off. I don't just want to help them, over the first 60, 90 days when we're getting this set up.
That's great. That's it's very interesting, right? And it's good to know because, from someone like myself who's not, you guys are experts in mortgages as well. So you see and understand these banks and who can do it and not. So I think that's great insight to know, is that you've got to be careful with who you're using to make sure that you can have those prepayment privileges to make the strategy work. Now,
exactly.
Can you tell me how does the Smith maneuver come into play? And again, what is the Smith maneuver? And does that come into play in your strategies where people look at using, if they've paid down these debts, now investing their money into an investment portfolio, should you say, again, using equity on your house to then make it tax efficient and tax deductible because you're borrowing to earn income?
Yeah. So the Smith maneuver, the best way to think about it is kind of the very kind of original version of this understanding that in Canada, we don't get to write off the interest on the mortgage on our home. And the flip side, when we sell our house, we get to, generally speaking, not pay capital gains. And so back in the 70s and early 80s, Fraser Smith, which is a brilliant man in BC, he was a financial planner, actually, effectively put together this strategy, called it the Smith maneuver. And within the Smith maneuver, there are several what he calls accelerators. So the strategy itself, as Sean mentioned earlier, aims to keep you in debt throughout the lifetime of your mortgage. So what does that actually mean? Well, every month when you're making your mortgage payments, a portion of that payment goes towards principal and a portion goes to the bank in interest. As you pay down the principal every month, you have access in terms of home equity that you've just built. And if you take that equity and invest it on a monthly basis, the expectation is that investments compounded at a rate of return will outperform the cost of the debt over time. But also, because you are borrowing to invest, and as long as the asset or the investment meets interest deductible criteria, or it's eligible for that interest deductions, you would then expect to see tax refunds or tax savings at the end of the year, depending on how you pay taxes for your work. So the Smith maneuver really is a personal pension builder. It's a brilliant way to stack better use of what we call debt equity, which is just the equity sitting in your home, to help you build a much better retirement plan whilst also generating some tax savings. And the Smith maneuver is really focused on that conversion, right? Let's make your mortgage tax deductible. And as I mentioned earlier, there are accelerators to that. And one of the accelerators in the Smith maneuver book is called the cash flow dam, which is effectively rental cash damming stacked into the Smith maneuver. So we're still taking the money out to reinvest on a monthly basis, but we're using a rental property or even a sole proprietor business to convert the debt faster for tax purposes. So it's really kind of the grandfather of a lot of these different strategies and how they get applied. Some of them are worthwhile pulling out and using in isolation, i.e. rental cash damming, or something that other people may have heard of as the debt swap. These are strategies that are really a part of that overall plan, but have been pulled out to kind of apply them with different principles. So cash damming is designed to help us get out of debt. The Smith maneuver wants to keep us in debt, but it's changing the nature of our debt to build more wealth in kind of the most tax efficient way we have available to us.
That's great knowledge, right? It's very, very interesting. So what are some of the risks, I guess, that people should be aware of, some misconceptions, and why is it important to work with professionals? And do you guys liaison with other professionals when you're working with clients?
Yeah. Every client's plan on our side is reviewed by a CPA. We have a partnership with one. She just makes sure that every step being set up is compliant with the CRA guidelines. There's a good question that I'm going to ask that Devon can answer that everyone seems to ask. So we are paying down your mortgage, which is typically at a relatively lower rate than a line of credit.
Yeah.
Most people ask, but isn't the line of credit rate much higher? And how does this make sense?
Yeah, so that's a question we get all the time. So the line of credit, and the reason it's done this way is we only have one tool that allows us to withdraw money from our home equity on a monthly basis in relatively small amounts. Unfortunately, we can't take out, $2,000, $3,000 mortgages on a monthly basis. It would be nice if we could, but we can't. So the line of credit is that revolving trade line that allows us to withdraw the money to manage the conversion process. And generally speaking, the line of credit sits about 0.5% above kind of the average mortgage rates over the lifetime of a kind of mortgage cycle, 25, 30 years. And there are obviously scenarios where if somebody's got a great rate locked in, that the line of credits might be substantially higher. But we're also in scenarios where the line of credit rate is sitting below what a lot of people have locked in on fixed rate mortgages right now. So what we generally tell clients is this conversion process is a 20-year strategy. The line of credit only needs to be used throughout your conversion period, which takes anywhere from, some people do it in 2 years, some people do it in 15. There are several strategies that we help clients with as we work through this process to effectively pull the money back off the line of credit and lock it into mortgage terms to eliminate what we call that interest rate arbitrage. There are just ways the money doesn't need to be on the line of credit to be tax deductible. That's another misconception we see a lot. It's why the money was borrowed. CRA calls it the purpose test. So it's why the money was borrowed determines the interest deductibility. How we structure the mortgage can be done multiple different ways, but that line of credit question comes up a lot. It's definitely something that we calculate and capture when we're putting together clients analysis. We actually take a look at the total debt or the total interest cost they'll pay on the line and the mortgage and compare that to what they would have been paying had they just left the mortgage as is. And predominantly, people will save into the tens, sometimes even hundreds of thousands of dollars of interest by doing this.
There's even cases where it will cost them more in interest to do this, right? We see it not often, but it costs $5,000, $10,000 or $15,000 over the lifetime of this process. But they're saving $150,000 in income taxes. They're mortgage free 4 years early and saving $250,000 in payments.
Right.
So it's okay sometimes to pay a little bit more because it unlocks all these other benefits.
Yeah, and I think that's where I'm sure a lot of people get stuck on the short-term focus, right? Like, are we just focusing on what's happening short-term, but not seeing all these benefits of filing in the way it's filing and using the deduction sources properly? As you said, what's the source and what's the reason for what you're doing? Well, your goal is to earn income, so therefore you get to deduct this. So I think that's a huge education piece and value that you guys offer that most people, again, it's too far ahead of them. But the fact that you can also run these calculations, and I feel like that's along with financial planning, right? Which is the world I used to be in. You're able to run these models to see, does it really benefit them? And so I think that's a great insight. So our high income earners, the rental properties or the basement rental, and then people really just trying to get ahead, right?
Yeah, exactly. And what I love is the opportunity cost. Like, if you can shave 5 years off your mortgage, and those payments would have added up to $200,000 over those 5 years. Like, you could be investing for an extra 5 years now instead of making mortgage payments. You could be taking incredible vacations. You could support children in school faster. You could retire early. That opportunity alone is huge.
It is. Wow. That's amazing.
Yeah.
Love
and
it.
then I think one more thing, like the pitfalls, right? Like, you're filing taxes, like almost like a self-employed person would. You need to follow these rules meticulously. You need to keep track of everything. You cannot commingle debt, because if Revenue Canada looks into this and says, well, you messed this up, well, you might have to pay back your tax refund. So work with a professional, someone who's done this themselves, someone who works with a CPA. We give clients 3 to 6 months of support where each month we're going through the money movement with them on Zoom. They have Loom videos. They have a whole detailed plan. We set people up for success, but you have to follow through with it.
That's great. I was going to ask, how does it it works. So that's great that you have those resources to hold people's hand, because I think people need that hand holding until they gain the comfort and the knowledge and have all the approvals that they're doing it right. Because as you said, that is what you've got to be careful of, right?
Yeah.
It's an approved strategy, but it has to be done correctly. So
exactly. And as you know, people will move during their lifetime, right? Like it's hard to imagine you're going to be in the same house for 25 years.
yeah.
So we are with them during those processes because you have to make sure the debt moves over correctly. Everything remains structured in a certain way to continue getting these benefits.
Right. Wow. That's great to know.
Yeah.
Thank you, guys. Okay. Is there any other common questions that people ask or that we haven't touched on that they should be aware of?
You know what? We've addressed probably the biggest ones.
Okay.
If they want to check out the mini course, it's 15 minutes. It's on our website. Towards the end of it, we go through some other common questions, but a lot of them get answered in that video.
Yeah, I actually listened to it last night again. It's great. So that's on freedom10.ca, right?
Yes.
Is where they
free
can
to
look
watch.
at that. I'll also put everything in the show notes so that people can see it, because again, understanding the high level strategy, going through the mini course, reaching out to you guys if someone is in this situation or could be in this situation now or in the future, I think it's great what you guys are doing. So also you guys have a big TikTok following, I think 19,000 followers and over 400,000 views per each of some of your videos, which is incredible. So it's Sean and Devon, and your tagline is Debt Cowboys.
Yeah.
Which is great. How did you guys come up with that?
We were just trying to come up with some fun names that would stand out. It was funny. We were talking to our Devon spouse and my girlfriend, and either hated it or loved it. And we kind of liked that it was like it's a fun thing. Like it's TikTok. Like, yes, this is a very serious topic, but let's have a little bit of fun. And I think our photo in the background is like mountains of money and like a desert. I wanted to put cowboy hats on us, but that got poo-pooed, and probably for good reason.
Yeah.
Yeah. So it was actually called Wealthy Borrowers for a long time. And then we just realized people probably thought this was more like a generic account sharing generic advice. But yeah. So the reason we went on TikTok is because I think it's one of the rare platforms where you can still go viral. Like Instagram is a lot more difficult. TikTok is more of an interesting space where it's pretty specific content rather than Instagram having 3 or 4 different ways of doing it. And we started last year and we were doing webinars. And we would use TikTok to get people to webinars. We would do real estate offices and stuff. And we realized people are now pigeonholed into one day of the month at this specific time of this day of the week. And we eventually built the mini course, and it was a condensed version of the webinar with animations. And we decided to start just doing TikToks. And like you said, a couple of them just hit. One of them is at almost 1 million views. And it's funny, like we started off very professional. I would have a dress shirt on and talking, and like we'd get no traction. And then I was in Mexico for a few months in the winter, and I was just doing videos in like a t-shirt. And for some reason, TikTok just liked the casual vibe. So those videos are a lot more casual than we represent ourselves. So it's really funny. So TikTok likes that stuff, and we've had great interactions with people and great arguments and great ways to just help people and have fun. And yeah.
I think it's people resonate with, I think, just being yourself too, right? Like we don't want to, if you're on those platforms, we're not like, they don't want to be in business mode, which makes sense. So it's incredible what you guys are doing and the education that you're able to give people. And I think it's so great when people can use this knowledge to their advantage. And again, just remember that little tidbit, okay, or my mom and dad has this, to be able to help someone else, and the mission that you guys are doing to help people get out of debt quicker and to do it tax efficiently, I think is exactly what we need. So it's amazing.
Thank you.
It's amazing.
Yeah, and I think that one of the reasons it resonates so much right now is because the cost of living is so high.
I know. And
people's mortgage rates have gone up, their payments are up, their groceries. People are struggling to put money away each month, even the middle class and people who are doing well. So these strategies just help put more money back in their pocket. And I think we found a way to distill that message in a clean and easy way for them to get that. So that's why it's resonating with a lot of people.
Yeah, it's excellent. Okay, now I want to ask you guys a few questions before we depart. Is there one book or podcast that has had a big impact on you, or that you feel changed your life in some way?
Deb, do you got one?
Well, Penny, we were chatting about this before we got on got on the call. I've got a son now, 6 months old. So The Intentional Father is an interesting book.
Ah,
Yeah, I was given that before he was born, so I've been reading it. It's a book that talks through kind of the psychology of raising a boy and what you want to pass on to him as a father, and how to try and raise him to be the best man he can be. So yeah, that's pretty profound.
I love
I've got
that.
like
What about you, Sean?
3 or 4 books that have stood out.
Oh,
I
wow.
can't choose just one. Think and Grow Rich by Napoleon Hill when I was a lot younger was great to kind of help paint a picture of the life I wanted to live. Like it forces you to sit down and like actually design what you imagine your life looking at and then work towards it. The Leader Who Had No Title by Robin Sharma. Really good book. Rich Dad, Poor Dad, I get it. It's like a huge sales funnel to improve coaching programs and stuff, but like conceptually, it was just a great little read. So I would say those. And then, yeah, let's stick with those 3.
Love it. Love it. Thank you, guys. And is there one powerful lesson or one key takeaway, if you could leave one thing today with our listener for them to take with them? Because I know it's a complicated thing for people to absorb. If there's one thing that they could take away, what would that be?
I'll go. I think I've had a lot of conversations in the past 4 or 5 months with people from TikTok who are feeling very overwhelmed. And there's a lot of information out there on what you should do, what you shouldn't do, how you can build wealth. One of the best ways to look at it is try to operate with as little debt and expenses as you can. Try to put as close to $1,400 a month away into the S&P 500 until you're able to start working with advisors and build difficult plans. But like, just save your money consistently as much as you can, even if it's $100 from the youngest age possible, and maintain debt levels low. And before you know it, you'll be able to buy that house, you'll buy that investment property, you'll be working with planners and doing more complex investments. But just keep it simple and relax. Don't buy the stupid car. Don't buy stuff you don't need. I've made these same mistakes. I wish I'd just saved my money consistently.
Yeah, I'd probably echo something very similar to that. Like, our business is on trying to help people put $1 saved back in their pocket. And sometimes $1 saved is just as powerful as $1 earned.
Yeah.
Right. So don't just focus on the earning side of things. Make sure you're looking at your finances holistically. Look at how you can save money rather than just how you can make more. Because oftentimes you can have the same impact without adding a bunch of stress to your life. And there's some really great ways to build in efficiency.
Oh, that's great. Great advice, guys.
How about you, Penny? How about your book and your lesson?
My book, Think and Grow Rich, was a great one. Think Like a Monk.
Mm-hmm.
Those are 2 kind of key ones that stand out. Any Tony Robbins book, love. Like he does a health one, a wealth one. Any of Tony Robbins things. Podcasts, Mel Robbins, love her. And piece of advice, I would agree exactly with what you guys said. Keep it simple. I think we complicate our lives. I think everyone thinks that or we compare ourselves too much too, right? Especially with social media now. Everyone's trying to compare and with everyone else and thinks that everyone's life is better off. But Instagram's the highlight reel. Everyone's showing their highlight reel. They're not really showing what life is. And at the end of the day, I've lost my mom, so I've seen it firsthand. Life is simple. It's about creating good memories with people you love, having nice times, raising a family. I have a daughter. And just enjoying yourself and fulfilling those dreams that you see in your mind, right? Like just going after it, but keeping it simple. Like we don't need to have, as you said, you don't need a brand new car. Why are we trying to keep up with the Joneses? Like if everyone just actually lived in their reality and like what they could actually afford, they could be using that money, as you said, to build up wealth, to build up this nest egg, to then have freedom to live the life they want. So
yeah.
It's simple.
Yeah, totally. None of that stuff matters.
No, it doesn't. And at the end of the day, right, if you're sick or you don't have your health, nothing matters.
Yeah.
So it's simple. Oh, that's great, guys. I just realized we're all wearing light colors. Did you see that?
It's just matching.
We didn't intentionally color coordinate, but we kind of color coordinate. So it's great. Thank you so much, Sean and Devon. It's been a real pleasure to have you. I'm going to link all of your stuff in the show notes for anyone who could use this guidance or you think it could be resonating with a family member or a friend. Please share it. We'd love for everyone to benefit if they can, right? So thank you guys for sharing your knowledge, and I look forward to seeing you soon.
Thank you, Penny.
Thanks, Penny.
Guys. Okay, take care.